Right now, we are being told that this is the best bull market in history. Fantastic. Excellent. Except it's actually a central bank bull market. If the Fed wasn't printing money for a decade, the market would collapse and economically, the weakness would be exposed. We know the weakness is evident because of the recent repo madness. The reason the Fed is buying treasury bonds in what we call QE4 is to allow the government spending and borrowing to continue without pushing up interest rates. They have to intervene at an alarming rate, otherwise the system would collapse without a doubt. You came here for the truth, so let me unveil that for you. I have an absolutely jam-packed episode to get into today. Several factors dealing with what's happening with the repo situation. They have now officially announced what's happening in 2020. I'll show you all the data directly from the source itself. I'm going to give you the charts. I'm going to give you all the relevant information surrounding that. We're going to talk a little bit about the ECB. I'm going to show you what's happening with individuals and their debt. All of this activity by the central banks has created the biggest debt bubble in history, and if they don't keep it going, of course, this will collapse rather fast. Debt needs to expand. We have to understand how this entire monetary system works, how it is built upon debt, how it spreads like wildfire. It's unbelievable, and let's get into it right away. According to CNBC, this is now the best stock bull market ever. Okay, that's what we're looking at. The question I have is, why did we get here? And of course, underlying all of which we have seen is the most interventionist policy from central banks that we have ever seen in history. Look at what is happening globally. All central banks have been printing money for 10 years, and we have watched interest rates get to just barely above where they were historically at the absolute bottom. If you look at what Europe did, they went lower and lower and lower. Some central banks did increase their interest rates, but not by much, and now they have begun to decrease them. This is a very big problem because in order to get interest rates to come down, the central banks have to print money. That's how this system works. I'm going to get into some more information beginning with the repos. From the New York Fed website, statement regarding repurchase operations. I'll just note a couple things in here. This was posted on November 14th, so it is brand new information right down here. The desk will also offer 3 additional term repo operations during this calendar period with longer maturities. Hold that thought. That extend past the end of 2019. These additional operations are intended to help offset the reserve effects of sharp increases in non-reserve liabilities later this year and ensure that the supply of reserves remains ample during the period through year end. Remember what I talked about here. Number 1, going into year end, they were talking about how they were expecting it to get worse, and so we could see an expansion, and of course here we are seeing that. Also, the longer maturities. I have been getting into all of this, and you know what's going on. Of course, we knew that this was going to move into 2020. The maturities would have to expand. If you look at it on the actual Fed website, which I'll show you in a moment, they give you the length of time, and you can see how long it is. It's not just overnight operations. There are also term repos. So you have the overnight operations, you have the term repo operations. Both of these together are something that they are actively doing. For some reason, I've been criticized suggesting that this is not the way it is, but they outline it right on their website, so I'm not sure where that comes from. But regardless, take a look at this here. You can see the schedule of overnight and term repurchase agreement operations. They list out everything that they're planning on doing. They give you these pieces of information, including this right here. So you could see, for example, this particular term operation on November 25th. The maturity date is into January. That'll be January the 6th. And the term is apparently 42 days. So that is much longer than what most people are aware of who even know what's happening with the repos. 42 days. And potentially we will see this go longer and longer. And soon it'll be 6 months and a year. And they'll buy the 30-year treasuries. And we are with the whole QE program yet again. This is what they're doing, except they are buying something else. They know what they're after. They know how this is all going to work out. They control the markets from top to bottom. The only only difference here is that they haven't outlined any emergencies at all. They have just begun to act. They have started to expand their balance sheet, as I'll show you in a minute, but they're trying not to panic the markets. They're saying, don't worry, we got it. We got this taken care of. It's just a small thing. Have no fear. We even admitted $190 billion being printed every single day, but it's just term repos. It's not QE. It's overnight operations. All of this sounds a little convoluted. Most people, even within the financial industry, have no idea what this is, and so we can continue our business. If you click on the second tab up there, operation schedule and parameters, it'll give you a breakdown on a daily basis. So if you're interested, you can see that for yourself. Let's move on to this one, which is the balance sheet of the Federal Reserve. And once again, I showed you this on a weekly basis as we have gone through here. It has moved up yet again, and of course, we will anticipate that this is going to continue to happen. Of course, they're not going to reduce their balance sheet. At least that's the expectation. They are right now today over $4 trillion is the expectation of the Federal Reserve at any point to reduce their balance sheet for any period of time. Are they going to do this because everything is apparently fine? No, they never stopped it. They took down their balance sheet for such a short period and such a small amount, it was insignificant. We're already back up over $4 trillion. And even though they said that this has nothing to do with the monetary policy, that's not what we're doing here. They're trying to tell the market one thing and then acting in a different way. They are way over 280 billion at this point, expansion from the bottom up to where we are. And it doesn't seem to be understood by the majority if they would only look into it. But of course, the sheep only know what they are told. This is the New York Fed website where you can actually see the repo and the reverse repo operations. And just to give you an explanation of this, if I zoom in here, we'll be able to see it a little bit better. The font is quite small, so you definitely want to check it for yourself. But you're going to see this, for example, the maturity date, and that gives you an idea of how long this is. You can also see the term of operation in calendar days and business days. In this case here, you see the 73.5. And if we were to look down a little bit further, we could see this 30.7. So together we're looking at, again, over $100 billion. Nobody seems to care anyway, but that's the real deal. Here you can see it on the chart right now, repo operations from the beginning, September 17th up until today. Clearly there's a need for this, and that need is actually expanding. We are watching it on a daily basis as the Federal Reserve is literally expected and needed and required to be there to intervene to make sure there is liquidity in the markets. That right there shows you that this is a failure. This happens to be the term repo operations. Same story every single day in and day out. There is a problem. So many people, if you look at the comments section, will not acknowledge this. But my goodness, we are watching the Federal Reserve admittedly intervening at a level of $190 billion a day on average since the beginning. And you're going to say that this is the best bull market in history? You are completely out of your mind. Reliance on overnight funding within non-banks has doubled since 2008. So since the financial crisis, we've broken the system. It's broken, it's finished, it's gone. This is a central bank system today. But many ignore the truth, ignore reality, and say that they will just print forever and ever. Well, why don't you ask your friends from Weimar, Germany, how well that worked out for them? What about Yugoslavia? What about Zimbabwe? What about every single example? 100% of the time where printing money has resulted in a complete collapse of the country. My goodness, please somebody mention Japan in there, because I love it. I absolutely love it when people say that, the ridiculous notion of the failure that is Japan's central bank. And now we can switch gears into what's happening with debt. This is directly from the Fed's website as well. They post this information regularly, household debt and credit report. I'm going to show you some data from here. We're looking at this information, not just directly, but I also want to link that to what the central bank has been doing. You know, when you keep interest rates really, really low, people borrow more because saving isn't going to do anything for them. Why would they put their money under their mattress? Why would they put their money in their bank when they're not going to get any return? The cost of living is continuously increasing, they have to invest. They have to do something. Think about it. If these people here leave their money in their mutual funds, they're going to get a return. At least that's what they believe. If they have it in a pension fund, 401k, they believe at some point in the future that's going to be worth more. So obviously that's what they're doing. They're piling the money in. There's a problem though. It's when you run into trouble. These pension funds are still suffering from the financial crisis. Here we are, apparently the best bull market ever in history, and the pension funds are still in a state of disarray. What do you think is going to happen in the next crisis? Are they going to slash pensions? Is the Federal Reserve going to bail out the average individual? That would be a first. We're in for a world of hurt. I'm going to show you some more data here. Obviously, you can see the total debt balance increasing as expected. I mean, my goodness, everybody knows this by now. The debt will simply increase month after month after month. Student loans, outstanding student loans stood at 1.5 trillion in the third quarter of 2019. That's an increase of 20 billion from the second quarter. 10.9% of aggregate student debt was 90 plus days delinquent or in default in the third quarter of 2019. I showed you just recently how this number is actually minuscule compared to the more likely accurate number, but it doesn't matter. More and more people cannot pay their debt. Auto loans are also having a problem. I have some data on that, and you can see here 90 plus days delinquent auto loans in the billions of dollars continues to increase. If you look at this on a percentage basis, it's not necessarily worrisome for most people because they see the number, well, okay, it's small, therefore it's not a problem. But take a look at all of this. Imagine what you have seen today with all of the loans that are collateralized and securitized. They are much worse than the public is aware of. Here you can see the auto loan balances in trillions of dollars, $1.32 trillion at this time. Now, that might seem small in comparison to the entire stock market or the entire bond market, but I'm not sure why people do that. They divide these weird numbers. They look at, well, the total amount of debt in the world is this much, and you're talking about 1.3 trillion divided to, oh, it's a small percentage, therefore not an issue. Remember the subprime crisis and understand that it was actually a small percentage of the total of homes, and yet it affected the entire world. The entire world was affected by the corruption, by the scandals, by all of that madness that was going on. Now, we have actually changed in many ways. There isn't as many of the subprime loans that we're looking at the same types of derivatives, but do you think for a second that these financial institutions are going to go and make less profit? Of course not. They're just finding new avenues, and I have highlighted those on many occasions. Auto loan delinquencies surged 90 plus days delinquent as a percentage of the auto loan balances, and we are basically at financial crisis levels right now today. It doesn't need to get to anywhere specific. It doesn't have to hit the previous amount. All you need to know is that people are more and more delinquent as time goes on. Auto loan originations by credit score. I just wanted to show you something here. So you see this information, and okay, so we can look at which of the groups, whether it's less than 620, whether it's above 760, and anything in between. It shows you the growth over time. Okay, so obviously more people after the financial crisis had deleveraged and they're ready to take on new loans and so on. But something isn't put on here that the Federal Reserve didn't mention that I have highlighted in previous videos is that they made changes to the way the credit score works to improve people's credit scores. They just wiped them off, and then individuals all of a sudden had higher credit scores. They did two separate things. So in fact, what we are seeing here is skewed numbers. I've highlighted that in previous videos, won't get into it today, but just wanted to show you that as well. Total debt balance and its composition, all of this is broken down, whether it's the mortgages, the auto loans, credit cards, student loans, everything in between. You're seeing that as it expands throughout the years. 2013, it started to go down, but as soon as 2014 came into play, we watched as the markets got the sensation that here QE3 is so fantastic and we've had all of this money printed before it. All the central banks are acting. Everything's going to be just fine. Interest rates are relatively low. And so spend. Two more quick things before I finish this video. The former European Central Bank President Mario Draghi will go down as one of the greatest monetary fools in history after negative interest rates failed to prop up Europe's economy, according to the former head of the Fed Reserve Bank of Dallas. So essentially what he said here was that he's a good guy, he's a good, smart individual, he knows his stuff, but unfortunately this was a big failure. I just wanted to mention the fact that this person here doesn't even realize the fact that the Federal Reserve is going to have to do the exact same thing. All central banks are going to have to act in this way, and it's ridiculous to think otherwise. And now to bring this full circle, hey baby boomers, lay off the stocks. That's the message from Fidelity Investments in its third quarter retirement report, essentially saying that people have put too much money into equities. This is very risky. This is not recommended. And of course, they give you more information here in the article. I just wanted to show you the fact that even Fidelity is telling people, watch what you're doing. You are way over your head right now. Be very careful and so on. The way that all of these financial companies work is that they have to make money off of fees, and this is when things are really changing for them right now, because the fee structures at all these companies are getting worse and worse for business, because companies like, for example, just recently Charles Schwab, no charges on their trades. Other companies have gone to a reduced fee structure for what their financial advisors are doing and so on. Big changes are coming to the entire industry, and of course that has an impact on the average individual. I'm going to end the video there. If you found it informative, hit that thumbs up button. By simply clicking one button, you are supporting me and this channel. This information is largely not found anywhere else. I don't understand why. It is all public, but nobody seems to be piecing it all together. So you could support my work by clicking a button on your screen. Thank you very much. If you want to learn how to build a business online, if you want to learn about passive income, I have a course. It's a step-by-step e-course that teaches you everything you need to know. It is 100% free. I created it for my subscribers exclusively. You could check it out at the AmazonGPS.com. If you received a formal financial education all throughout your school, maybe your parents taught you everything you need to know top to bottom, you learned about the history and the foundational principles of money, then you don't need to read these two books. Otherwise, these two books will help you get everything you need to know without any jargon, without any garbage. Check them out at the link in the description if you want the audiobook that's available at themoneygps.com. Wait a second, hold on, don't go anywhere. You were about to click off. Don't do that. You have to watch this video. All of the information is here. Click on it and I will see you there.